This is Insightful Value, where we uncover the stories behind undervalued companies and simplify the data so you can see opportunities others might miss. Today we are diving into Hilton Food Group, a company whose stock price has dropped to low levels, making many investors wonder, is this the right moment to look closer? Before we begin, remember this video is for informational and educational purposes only, not financial advice. Make sure you subscribe to our channel, hit the like button if you enjoy this kind of analysis, and leave your thoughts in the comments. Hilton Food Group is a specialist international food packaging business headquartered in the United Kingdom. The company supplies major retailers with packaged meat, fish, and plant-based protein products, and has expanded its portfolio to include ready meals and sustainable alternatives. It operates across Europe, Australia, and New Zealand, working closely with large supermarket chains to ensure consistent supply of fresh food. From a value investor's perspective, Hilton Food Group has an interesting profile. Its revenues have been steadily growing in recent years, largely because of its expansion into new categories such as plant-based proteins and the acquisition of Seachill, which strengthened its seafood business. However, its profit margins are typically thin, which is common in the food packaging sector. Rising input costs, such as energy and raw materials, have squeezed margins further, putting pressure on earnings. Dividends have historically been paid consistently, but growth in dividend payouts has slowed in the last few years as the company prioritizes reinvestment and managing higher costs. The most recent financial results showed revenue growth supported by new business wins. Yet profitability was weighed down by inflationary pressures and weaker consumer demand in some regions. Management has signaled plans to optimize operations and focus on innovation in plant-based and sustainable products, areas with longer-term growth potential. Why is the stock down right now? Several reasons stand out. First, the inflationary environment has made raw materials and logistics more expensive, and while Hilton passes some of these costs onto retailers, not everything can be absorbed without hurting demand. Second, consumer behavior is shifting. Shoppers are trading down to cheaper alternatives, which puts pressure on premium packaged products. Third, the overall UK food retail market has been challenging, and Hilton, being tied to major supermarket chains, is highly exposed to those pressures. So, what are the chances of a recovery soon? If inflation continues to ease and consumer spending stabilizes, Hilton's margins could slowly improve. Their diversification into plant-based ready meals in international markets gives them resilience. The company's long-term relationships with retailers also act as a buffer against losing major contracts. However, risks remain. Sustained inflation, currency fluctuations, or loss of a major retail client could hurt performance. Why might an investor consider Hilton Food Group right now? The low stock price could signal undervaluation if you believe in the company's ability to recover margins and grow new segments. Why might one avoid it? Because food packaging is a low-margin, highly competitive industry, and recovery may take longer than expected, with dividends unlikely to grow fast in the near term. At Insightful Value, we provide in-depth analysis of undervalued companies, breaking down the key data without jargon. Whether you are a seasoned investor or just starting out, our goal is to simplify complex financial concepts and highlight where real opportunities might lie. More information about Hilton Food Group and many other companies can be found at insightfulvalue.com. Don't forget to subscribe to our channel, like this video, and share your thoughts in the comments. If you want us to create a review of a company of your choice, we charge only $20 per review. Contact us at info@insightfulvalue.com.